market trading near multi-year highs, you might want to exercise your stock options, but you should be aware of the potential consequences of doing so. Rob Johanson joins us from Los Angeles to talk about this. He's an accountant and financial planner with NBS Financial Services. Rob, good to see you. Thank you for being with us.
Hi, Ellie. Nice to see you again.
Stock options were just really not an issue over the last couple of years when markets weren't doing anything.
Right.
Most people's options were underwater. But options have been, they really came into being in the late 90s. It wasn't something that just happened to senior executives. This is something that people started offering across the board. I know at Time Warner, when we got ours, people sort of shelved them, didn't really pay any attention to them. And now all of a sudden, you walk around the office and everybody's talking about what they should do with their stock options. It's, you know, it's
right.
back in vogue.
Right. And basically, options are compensation driven. There are two basic types, qualified and non-qualified options, and you have a little more flexibility with what you can do with the qualified options, the employee stock purchase plan, and the incentive stock option.
Let's talk about it. If I hold options in my company and I feel like exercising them because they are above the price at which my options are issued, what do I need to think about?
Well, if it's an incentive option, you have to be very concerned nowadays with the effect on your tax return. We talked last time I was speaking with you about alternative minimum tax, and that's a significant issue now because many people are already in a position where the alternative minimum tax and their regular tax calculation are very close. And remember,
you pay the over. Yeah, you have to pay the one that is higher.
Right, and if you're that close, anything you may do with an exercise will cause you to be over, and how significant that becomes is a big issue.
How do you keep the tail from wagging the dog on this one? How do you, let's say you decide it's the time to exercise your options, and that's the advice you're getting, and it may well be the time to exercise your options. Is there anything you can do about it that prevents those tax consequences from kicking in?
Well, the first thing you should probably look at is some sort of a break-even point analysis between regular and the AMT tax. Because essentially when you exercise an incentive option, you've set a floor for your tax result. It will not be less unless you sell that stock for a lower price than the value on the date you exercise. So the first thing we look at is there a point at which you can disqualify some stock, sell it before the one-year holding period is up, and actually raise cash without changing your tax result materially.
And when I said earlier that you don't want the tax tail to wag the dog, one has to be concerned that if you incur greater tax liability as a result of exercising options or just selling stocks at a gain, you could get yourself into a liquidity issue.
Right, and that's very common as well because there's obviously a price to buy the stock and there's a tax consequence to holding the stock. So many times people will borrow money against their position, maybe on margin, which can be a dangerous thing to do with a stock that is very volatile. They may borrow against their home equity. That's also non-deductible if you're in an alternative minimum tax result. So you have to be careful about where you raise the money. One of the things we recommend often is stock swapping, which is a way to preserve cash, at least to the extent of the exercise price.
Tell me about that.
Essentially, if you have employer stock that you've been holding for the 1 year or longer time period, you can exchange that stock instead of giving them dollars to purchase the stock. You can exchange existing stock you own and swap it to cover the purchase cost of the new shares. Essentially, what happens is you acquire those new shares with a no-cost basis. And the alt-min calculation is based on the shares you've acquired. In other words, they have a zero basis, but the value of the stock on the date of exercise determines the spread.
What's typically the basis is the point at which the stock is the strike price of the option, am I right?
Right, except we have two parallel systems, if you remember our last discussion, and you have to keep track of both of those. The regular basis is the price you pay, and the alternative minimum tax basis is the fair market value of the stock on the date of exercise. So actually, when you sell that stock later, you're going to calculate your gain under both systems using different bases.
Rob, all good advice, hard for the average person to calculate. Where do you go for this? What do you do? Do you have to go to an expert, or is there some kind of tool that you can use to do this math?
Well, there's a lot of web-based information that you can get, but I think it really works the best if you have someone who's knowledgeable in the area and you can talk to. I know with my clients, generally it'll take 3, 4, maybe 5 times to really have them understand both systems and the impact, especially since these issues carry on well beyond the current tax year. because you develop things like alternative minimum tax credits, which you have to manage, and things like that.
You know, I so as a business journalist would love to dodge this alternative minimum tax discussion, but you just really can't, can you? It's a big one.
Not today.
It's not one of these ones you can make into an easy conversation. Rob, good to see you again. Thanks for being with us.
Okay.
Rob Johanson is, thanks. He's with NBS Financial Services joining me from L.A.